All right, we'll go ahead and kick off here as folks continue to dial in. So good morning, good afternoon, and good evening, depending on where you are in the world. My name is Sophia Aaron, and I'm the Global Blockchain Business Council's Communications and Content Lead. It's my pleasure to welcome you today to the GBBC Virtual Members Forum. This is a bi-weekly webinar we host showcasing the innovative work of our members around the world. And today we have the pleasure to be joined by Andrew Kiguel, co-founder and CEO of Tokens.com, which is a publicly traded company that owns an inventory of DeFi and NFT-based cryptocurrencies. And through a process called staking, they use their inventory of cryptocurrencies to earn additional tokens. Today, Andrew will give us an overview of Tokens.com and how they view the evolution of blockchain, DeFi, and NFTs through crypto staking. And just briefly before we begin, I'd like to introduce Andrew. As I mentioned, Andrew Kiguel is an accomplished executive with leadership experience in Canadian capital markets, corporate governance, and entrepreneurship. And he was the co-founder and CEO of Hut 8 Mining, one of the largest publicly listed Bitcoin miners in the world. Prior to that, Andrew spent over 18 years in investment banking, with his most recent title as managing director and head of retail real estate banking at GMP Securities. Currently, Andrew is co-founder and CEO of Tokens.com. We're so pleased to have him here with us today. And so if you're joining us live, you can ask questions by submitting them in the Q&A chat at the bottom of your Zoom screen, and we'll take them after Andrew's presentation. Thanks so much, Andrew. Over to you.
Thank you very much. A pleasure to be here. I think as I was sort of to speak about what I'm going to talk about, it's the evolution of crypto and the crypto processing, be it from proof of work to proof of stake, and really how that's driving crypto going green. So to start off maybe the top, and before I get into tokens, I think it's always worthwhile to start at the beginning, which is Bitcoin. And I like Bitcoin. I own a lot of it. However, if you go back to the origins of Bitcoin, when Satoshi Nakamoto, and for people that don't know, people don't really know who the original group or person or group of people were that invented Bitcoin. But when it was planned, it was done via a system called proof of work or crypto mining, as it's well known today. And obviously there's a lot of different companies doing it today, but back when this was started back in 2008, so this is almost 12-year-old technology, I think the original premise was that this was going to be done by people in their home computers. It was something that hobbyists would do on behalf of the Bitcoin network. And if you think back to 2008, what was going on, the world had just come, or it was coming through the Great Recession. And the person or the people who invented Bitcoin, this was really almost like a counterculture. This was a form of saying, we don't trust the banks. This is a way for us to do peer-to-peer transactions and do it ourselves through this other system. And the form of validating that was proof of work or crypto mining that people could do from their computers. And in return for providing this service, you would be rewarded in additional Bitcoin. So fast forward a few years, as Bitcoin started becoming more popular back then, far less so than it is today, there was the invention of something called the ASIC chip, which stands for Application Specific Integrated Circuit. And it's a specialized chip that was developed that could do the same thing that you could do in crypto mining on your computer, but it could do it so much faster, infinitely faster, so much so that really doing it on your home computer became obsolete. What this did is it actually drove the mining of Bitcoin away, and really crypto mining is about getting processing power, which was supposed to be done through your computer. So your computer is the hardware and electricity, and using that as a way to validate blocks on the Bitcoin network. With the invention of the ASIC chip, and with companies starting to produce this, it started to turn into more of an industrial, commercial endeavor, whereby today, I don't know anybody who still does crypto mining on their own at home. It's all done by these large, massive companies. And if you go back to 2017, a lot of this started going commercial, and that's when I pivoted into the blockchain world, had the notion that people wanted to invest into things like Bitcoin through the public markets. And there wasn't really a way how to do that back in 2017. This is before the crypto miners were public, before Grayscale, I think, was just starting. There weren't the ETFs and funds that are available to investors today. So back in 2017, along with some other people, co-founded a company called Hut 8. And the name Hut 8 was really a tribute to Alan Turing, which, if you don't know, during the Second World War, at a place in England called Bletchley Park, he really created the world's first computer and helped to decode the German Enigma code, which was really a way for the Allies to end the Second World War by sort of interpreting and getting information back then. And so that's where the name came from for people who are curious. But when we started Hut 8, the real, I guess, problem that we were trying to solve is to create a Bitcoin mining company that held all of its Bitcoin. And by virtue of its holding its Bitcoin and taking that company public, that would give people exposure to Bitcoin. And that worked. Today, Hut 8 is a company that has about close to a $3 billion market cap. And I think the fourth or fifth largest holding of Bitcoin in the world of any public company, behind MicroStrategy and Tesla and a couple of other big names. But back to the evolution of how this got into staking is, as Bitcoin became more popular and there were more cryptocurrencies added like Ethereum and various others, they piggybacked off of this proof of work technology. And as it started to proliferate and more tokens and more people started mining Bitcoin, what ended up happening is that you created this massive need for energy in order to process not just Bitcoin, but really all of the other cryptocurrencies. And this has got a bit of an image problem today. Certainly for sure, Bitcoin has been a lightning rod for environmentalists. And I know when I was running Hut 8 and I was a CEO there, I used to get frequent calls from people in the media and environmentalists saying that, we were hurting the planet by using up all this electricity. And now, while I don't exactly buy that argument, I think there's always a cost. As a company that was validating blocks and keeping the Bitcoin network secure, nobody would call up Wells Fargo or Bank of America and say, you're using too much electricity keeping my money secure. However, it is undoubtable that as the cryptocurrencies and Bitcoin become more and more popular, that use of electricity continues to grow. And that's certainly a concern and an image problem. So how does that lead to staking and where we are there, and how I think staking and DeFi are really leading this, what I would call a green revolution in crypto? A couple of years ago, people looked at this proof of work crypto mining system to validate blocks, and I think they said, this system doesn't make sense for a couple of reasons. It's got a lot of flaws. It worked originally and it still works for Bitcoin, but it doesn't work for all these other great innovations that we're doing in the crypto space. And so they looked at the system and they said, why don't we remove or find a new system that, instead of using electricity and hardware and vast quantities to validate blocks, we create a different thing. It's something different where you're putting skin in the game, so you still have something at stake, literally at stake. And that is, we will make people buy the token to perform the same work as a crypto miner. And so a staker or crypto staker that uses proof of stake does the exact same work as a crypto miner. They get compensated similarly, except the crypto staker does not need to buy any hardware, and the process uses 99.9% less electricity. So near zero electricity use versus crypto mining, which is estimated to use about the same amount of electricity as the country of Argentina. And so this was quite revolutionary, and for people to want to adopt this. There was another key thing, which was scalability. And another problem with proof of work or crypto mining is that it's slow. It doesn't process many transactions per second. It's estimated it can process about 15 transactions per second. And so this is great for something like Bitcoin, which is not really used as a form of instant payments. People use it more as a store of value today. And there's certainly a lot of trade that happens into it, but it doesn't require that same volume of transactions that something like decentralized finance or the NFT world requires. And so it's really this demand for DeFi products and NFTs that is driving the crypto world to move from mining to staking, because it's faster and it's cleaner. So maybe with that, I'm going to move into my presentation. I just wanted to give that background because really everything comes back to Bitcoin. And as I said, I love Bitcoin, but it's undeniable that the mechanism or the operating system of crypto mining requires a lot of electricity. So fast forward, I was running this very large Bitcoin mining company, and I started doing the research, and I found that this new technology called staking, and how you can do the exact same work as a crypto miner without electricity and without hardware. And I got really excited by it, and very much like the rationale behind Hut 8, which was to bring this to public market investors, which was an area where I had, really cut my teeth in my career earlier. I said, why don't we create a publicly traded company that does staking instead of mining? By the time I left Hut 8 in 2020, there was probably already 30 or 40 different crypto mining companies. Today, there's probably 100 public crypto mining companies out there, but there was no one doing staking. And so I wanted to get ahead of that curve and provide that to the public market early. So today, what Tokens.com is a company that owns a collection of DeFi and NFT-based cryptocurrencies. They're layer ones, which means we're buying the operating systems that DeFi and NFTs are used to be built on. And through this process called staking, we're using that inventory to generate revenue exactly in the same way that a crypto miner would do that. We also co-own something called the Metaverse Group, which is basically 3D worlds in the metaverse, and we're buying up real estate there. It's very cool. I'm not going to focus on that today, but certainly if you go to our website, tokens.com, there's a lot of information about this NFT-based real estate in these metaverses that are out there. So again, what's the problem that we're trying to solve at tokens.com? And I think it's a common problem. Crypto assets are eclipsing all other assets in the world on returns. I think Bitcoin has been the top performing asset in the world 8 out of the last 10 years. And if you look at things this year, even like Solana, Ethereum, and other things, certainly the performance is outstanding relative to other areas. This is to the point that Fidelity now recommends a 5% allocation in everyone's portfolio to crypto. But it's still intimidating and challenging for people. Like, how do you do this? And I remember the first time I bought my Bitcoin, and I don't think the mechanism is that different. You have to go through a process of opening up an online wallet. So there's the know your client, the anti-money laundering, the KYC AML that you have to go through. You have to prove your sources of income, where the money's coming from. This is all good, but it can be intimidating. They also limit you for a while as to how much you can buy. I think as a Canadian, you're allowed to buy $500 worth of crypto a week through Coinbase. There's also the whole process of wiring money offshore. Now, today, something like Coinbase is well known, but people still are preferring to buy their crypto, if they can, through the public markets. And there's great evidence of this. There was the ETF in the United States, the Futures Bitcoin ETF launched, I think it was last week, and it saw record inflows in trading in the first few days. In Canada, we launched the world's first Bitcoin ETF earlier this year, and that attracted billions of dollars within a week. That to me says that although something like buying Bitcoin is super, I would say, straightforward and easy to do, people still prefer to buy their crypto, if they can, through their existing online public market accounts. They want it to be lumped in with the rest of the stock portfolio that they own, and they don't want to be creating these other wallets yet. I think they still find it intimidating, and some of it's challenging. If you've ever gone to some of these websites, PancakeSwap or Aave, there's a lot of different things going on, and the learning curve is quite high. At tokens.com, the mission is to make this easy. As a public company, we take our capital and we invest it directly into these tokens. And so by owning our common shares, you get the direct exposure to that. And again, we're not sitting passively on these tokens. We're using the staking mechanism to make sure that we're earning some more capital. Our largest shareholder is CI Signature, which they are one of the largest, if not the largest tech fund in Canada. And they own about 9.9% of our company. The reason why is they say, look, as a fund, we just don't have the setup ready to go out and buy crypto on our own. We don't know how to set up the security or the tax reporting that's involved in holding it on our own. But Andrew, we can own tokens.com and we have liquidity through that. And that gives us direct ownership through your shares to the assets that you own in the crypto world. I'm going to talk for a second about DeFi, although a lot of people are probably familiar with this. And again, this is, I think, the primary driver into staking. DeFi refers to decentralized finance, and it is a very, very hot topic these days. And the reason why is it started as a fairly small industry, a year and a half ago, has really ballooned. And the numbers that you see here are recent, but already somewhat outdated. So DeFi refers to new platforms aimed at retail investors and interested parties that allows for them to transact peer-to-peer through smart contracts with each other and doing financial services on their own without the use of a bank or other form of institution like an exchange. Today, the estimates are that there's over 7 million people that have deposited close to $200 billion into these different systems for the use cases of borrowing, lending, and trading, amongst other things, anything that you can apply a smart contract to. Wall Street and Silicon Valley are really going bananas over this. They see this as a way to capture the financial services revenues that are right now going to the banks and put this into applications where people are transacting and paying fees to these exchanges. It's a massive market and growing. If you read up on it, there's tons of new money being raised in Silicon Valley for new funds devoted specifically to DeFi. Now, how does this tie into staking and proof of stake? As I mentioned before, pretty much every blockchain uses either proof of work, which is crypto mining, or staking to process their cryptocurrency transactions. Proof of work, which is performed by the crypto miners, is old technology. It was developed in 2008. And as I said, I don't think they ever envisioned, the creator, that it would balloon to this industrial process using up the electricity that it uses today. It's really evolved and it's got its issues. It's heavily criticized for the vast energy consumption. Proof of stake is a relatively newer technology that is really starting to dominate the crypto space. And I'll provide you some numbers in a second that I received last night. But proof of stake requires purchasing the token. The people who developed it, I think, looked at the crypto mining process, or operating system, as I like to call it. It's a little bit like iOS and Android. It's an operating system that things are built on. And proof of stake was created to solve the two big flaws of crypto mining. And so staking is performed by buying the token. So whereas a crypto miner would use his capital to buy machines and pay for electricity to run these machines, which is quite high, a crypto staker instead buys the token and puts the tokens at stake to validate transactions. And so you're rewarded for processing the transactions properly and making sure that when transactions happen, one area is debited, one area is credited. And the way to get your seat at the table to the staking party is to actually own the tokens, and you put them at stake. It's almost like having them as collateral. This is a vastly better system because you're not using electricity, you're not using hardware, so it uses far less electricity. And I'll get to the other main point as well, which is scalability. But this system is so, I guess, superior to what's happening in the crypto space that Ethereum, which is the second largest crypto in the world, and the main building block or operating system for DeFi and NFTs today, is converting their entire platform to staking. I'll give you the other reason why here, but again, proof of work, high energy consumption, old technology, capital intensive. Here's a big one here, which is the third point down. It can only really process about 15 transactions per second, okay, approximately. So you can see the scalability issues, and some of you may have heard about the high Ethereum gas fees that occur. That's because when things are being built on Ethereum or there's a new NFT drop, it's a little bit like drinking water through a pinhole. The volume of transactions that's trying to get processed on a system that can only do 15 per second is too big, and it ends up creating a bottleneck. This is why they're converting. Now, put it in perspective, Visa and MasterCard can process 20 to 30,000 transactions per second. So crypto mining 15, Visa, MasterCard, 20 to 30,000. Proof of stake operating system can process 100,000 transactions per second. This is one of the key reasons why Ethereum is making this switch and why they just can't wait to get there faster, is because this will eliminate those bottlenecks. This will allow the processing required by DeFi and NFTs to be handled in a faster form. As I always like to say, DeFi's goal here is really to revolutionize the way financial services are delivered and offered to consumers. Well, you can't do that with 15 transactions per second. And so every new token that's been built over the last year and a half has been built on the staking operating system. And you can look at the Cardanos, the Tezos, the Solanas, the Polkadots. Nothing is being built on crypto mining anymore. Nothing. I can't name a single example. I'll give you another example here is that 2 years ago, out of the top 10 tokens, 0 would have been built on proof of stake. Today, I believe it's 5 out of 10 that are using the proof of stake system. And I would even venture to predict that in 2 years, 9 out of 10 of the top 10 cryptos in the world will be operating on a proof of stake system. I think that crypto mining has its use, particularly in Bitcoin. However, it's old technology and it's really on the way out because, you know, all the transactions, the exciting things happening in crypto are all being done on staking. Here's just some statistics, and these again are recent, but became outdated as of last night. The number of out of the top 100 cryptos that are now on staking is closer to 35. The payouts, this was estimated by JP Morgan. So JP Morgan, the most skeptical of all investment banks, put out a report on staking in July. And a summary of that is on our website at tokens.com. But they estimated $9 billion in payouts to crypto stakers this year, growing to 40 billion by 2025. And so very much like back in 2017, when crypto mining was sort of at its very early stages, crypto staking today is at its very early stages, and the growth is starting to go like this. In fact, this report that I read last night said that 50% of crypto's entire market cap now belongs to crypto staking tokens. So think about that. It went from 0 2 years ago to now being 50% of the entire market. And again, I'm going to venture to say that outside of Bitcoin, the entire market is going to shift to crypto staking within 2 to 3 years. At tokens.com right now, we're the only public company with a core focus in this area. So these are the assets we look at. And I think I'm not going to get too much into here. I don't want to be here to promote tokens.com, but I'll tell you the reason why we own these tokens and the reason we're staking these. The way I like to look at the crypto market is in layers. And as I mentioned, the first layer, the one that interacts with consumers, is really the apps. If you think about this as Ethereum and these other tokens being like the operating systems, which I keep using, like iOS, and then you have like the apps that are built on top of these operating systems. We're focusing on that layer that is the infrastructure or the operating system layer, because we believe when you look at this from a macro trend, DeFi and the NFTs are going to continue to grow. We want to be part of owning that operating system. So to put in perspective, the first layer deals with consumers would be built on top of tokens like this. So that would be the Aves, the BlockFis, all of these other things. These are the websites that you would go to, deposit your crypto, and you'd be able to engage in things like borrowing and lending and trading. They would be built on something like the Ethereum network, which is still the dominant building block for DeFi and NFTs. And at the bottom, you would have someone like tokens.com, which would be the staking entity that is helping to validate those blocks through ownership of Ethereum. Again, you never see tokens.com, just like when you go to these websites, you don't see the Ethereum platform either. But really, these are the building blocks that are helping the DeFi and NFT spaces grow. So I'm going to talk a second here about NFTs. I think everybody knows what NFTs are and the massive popularity they've received this year. What a lot of people still don't realize is that most NFTs are built, stored, and traded on the Ethereum network. And so again, this just goes to this growth of NFTs, which is today, when something gets dropped and they're doing this conversion of their entire platform to staking, it's a gradual process. It's not a light switch where you go from mining to staking. It's called the merge, and it's taking place. It should be done in about 12 months. But every time there's like an NFT drop that happens and the volumes of people trying to get in there and to buy this stuff, it really slows down the Ethereum network because it can only process the 15 transactions per second. And so I think this transition to staking is not only going to lead to more DeFi projects that are more dynamic, and NFTs and the use of NFTs that are more dynamic and in ways beyond sort of, CryptoPunks, which I think are great, but I think there's more that can be done with this technology. But it's just really converting the entire system from being something based on processing energy to something that's based on ownership and is quite green. I'm going to skip the metaverse stuff, but again, from Tokens.com's high-level strategy, we've identified what I would say is large macro trends and movements in the crypto industry. To me, DeFi and crypto staking are huge. I think this is a massive game changer for the crypto world. Next year, I think the two hottest things in crypto are going to be staking and metaverse real estate, which are the two things that we focus on. We like to purchase the assets that we think will appreciate as a result of these trends and movements. And then we're using technology to generate revenue from it. So things like crypto staking, which I've already talked about, and why I think that's quite profound. The other thing I'd mention about crypto staking that I think is really interesting is that when you're crypto staking, the payouts in crypto staking are paid to you in the token that you're staking. And so we started staking ETH back when it was at $900. I think it's at about $4,200, $4,300 today. And we're receiving that token. So every time the value of ETH increases, the value of our payout increases. And so there's lots of sites out there like stake.us and in Coinbase, which will show you that they call them the yields that you would receive through staking. But I would say those are very understated. And the reason why is because if you're receiving, call it a 5% payout in additional ETH for staking ETH, and the price of ETH doubles, that becomes 10%. If it triples, that becomes 15%, and so on and so on. And as long as you're continuing to get paid in that native token, it doesn't matter if the price goes up or down, you can continue to build your inventory. And that's been the strategy that we've had at Tokens.com. So again, I hope that sort of explains why I think that the entire crypto industry is moving towards staking, again, out of necessity for the processing power and to reduce its carbon footprint. And as more and more things are built into DeFi and more applications become usable by consumers, and as NFT market grows, I think that it's an inevitable shift from crypto mining to crypto staking. So maybe with that, I'll turn it back over to Sophia, and I'm happy to answer the questions.
Excellent. Thanks so much, Andrew. And to everyone who's tuned in, please feel free to continue entering your questions in the Q&A box, and we will take them now. So we've had a number of questions come in. I think some of them you've already addressed. So somebody asked sort of, what kind of cryptocurrencies does Tokens.com hold? Feel free to expand, but I know you had a slide on that. So
yeah, so and our presentation is available on our website. We don't want to be the token of the month club. We focus on the layer ones, which are really, I would call, the operating system tokens that people use to build DeFi applications. I never want to bet on which product is going to succeed with the consumer. I'd rather bet on the operating system. And maybe to give you an example, it's a little bit like Amazon Web Services, which provides cloud to a whole bunch of different places. Ultimately, they may not care if it's Netflix, YouTube, or whatever else that is winning the, or just like maybe we wouldn't care if it's Facebook, Instagram, Snapchat, or TikTok, or whatever. They just care that the industry is growing. I like to take the same approach. I know from a macro perspective, this is going to grow, but I don't really want to bet on which specific application is going to be successful with consumers. By buying a piece of the operating system, I feel that my chances of success are a lot better.
Adding to that, and I think this question, somebody's just asking for a little bit of an overview of what you mean by these layers and the apps in crypto.
Yeah.
Perhaps you can distinguish between sort of layer one, layer two.
Yeah, I'm going to share my screen again. So simply put, in the crypto world, tokens are generally referred to as layer one, layer two, or even layer three. And what that means is something like Ethereum, which you can see here on my slide, is its own token, but because of its smart contract capabilities, it's really like a programming language. And so yes, it trades and you can own a piece of this programming language, but it's actually a very useful tool for people who are creating apps. And so you can see here below the Ethereum logo, these are all different applications targeted at consumers that are built on the Ethereum blockchain. So think about it as Ethereum being the highway, these applications being the cars, and every time they're driving through, there's a toll that is paid to the Ethereum. So something like Uniswap, you can look up, has its own token, probably has like $10 billion deposited with it. There's Aave, Big, and Maker. There's a whole bunch of different applications here that are built. On top of this, the NFTs are also often built and stored and traded on the Ethereum network. And so Ethereum is the layer one. The layer twos would be the programs built on it. Again, think about it like iOS, and the things built on it would be like the apps in the Apple Store. Where tokens fits in is we're kind of hidden as the infrastructure below the layer ones, because as any transaction happens, so somebody goes and deposits and does something at Aave or Uniswap or any of these, or any of the other probably thousands that are built on Ethereum, they have to pay a fee down to the layer one they're using. The layer one needs to have a way of validating those transactions. And so companies like Tokens.com would then get a fee for processing those blocks. And so that's why I say we're kind of hidden at the bottom as beneath the layer one, providing that infrastructure support. You would never see us. You would never actually see Ethereum when you're using these applications, just like you would never see the programming that happens if you're downloading an app off the Apple Store or the Google Store. But they need to be built on something. And as I was saying, I don't want to bet on which one of these is going to be successful with consumers. At Tokens.com, I think the opportunity to own a piece of the operating system that they have to be built on is quite incredible. People often say that, crypto is a little bit like owning a piece of the internet when you're owning things like Ethereum and Bitcoin. And this is what they mean. I can own a piece of the operating system that people are using to build things. And I think that's quite remarkable and quite an opportunity for investors.
Thanks. I think Dan's question sort of feeds into this, and he asked sort of, what's the total addressable market and what's the opportunity look like 2-3 years down the line in terms of the growth that you expect to see?
So the growth, it's a loaded question. As a public company, I don't like giving a forecast. I would say that the addressable market is gigantic. If you think about financial services right now are generally operated by pen and paper. I'm from Chile originally, and I occasionally send money to help out my cousins down to Chile, and using the SWIFT system is extremely cumbersome. And what I mean is I have to go to the bank, I have to fill out a piece of paper, I need addresses, SWIFT codes, all of these things. I give them the money, they take 9% here, 3% there, and maybe it arrives in a week. There's no reason why blockchain technology or technology in general shouldn't be used to upgrade this, other than the banks are continuing to try and protect their fees. You can send capital anywhere you want through some of these programs legally after doing KYC and AML. It'll take you 10-15 minutes to get the money there and cost you less than $1. Why do people need to continue paying these exorbitant fees? Other things like trading. Why does trading have to happen between 9:30 a.m. and 4 o'clock in most countries? People want to trade all the time, and you can see this already happening. So it's about just bringing technology to financial services. And so, I mean, how big are the banks? Foreign exchange is the largest business in the world. The market is massive. In terms of tokens, I think our opportunity is quite large. I think the more people are using things like Ethereum or Polkadot or the other assets that we own, the more their value increases. And so by owning a piece of that operating system that is fueling the change in financial services, we will be part of that. And so it's hard to really put a pin on it. I think it's going to continue to be volatile, but it's a massive market.
Thank you for that. I hope that answers your question, Dan. A few people here have asked, so what's the typical lockup period for staking? And then adding to that, why is staking currently limited to 365 days? What prevents the cycle from being more than a year?
Okay, so staking is not prevented. So the lockup periods are different for every token. So something like Ethereum, if you're staking Ethereum, you're bonding to that network, and until that merge is completed, your tokens are essentially locked up. there's certain ways you can do trades and things with people, but essentially, once you're bonding your ETH to the network, it's there until the conversion is completed. For something like Polkadot, it's 28 days. And so you bond your tokens if you want to get liquidity from that 28 days. One of the value adds that we provide at Tokens.com is that we trade Monday to Friday during market hours. And so you can get full liquidity through us that you wouldn't get through staking. In terms of the 365, I think what we were saying, it's not that you're set to that period. Maybe someone saw that in the presentation. I think the point is that when you're running a crypto mining company, you have a lot of downtime. When I was running Hut 8, I would get calls sometimes at 2 a.m. that a transformer blew, and I'd have to gather up engineers and stuff in Medicine Hat, Alberta, to try and get things fixed. The staking process is a lot more simple. I think it's going to be here for years to come, and I think it's already becoming the dominant technology in crypto. And my point there, though, is that you can perform it 24 hours a day, all year long, without any downtime.
Another question here that's come in is, so I think you mentioned that if you looked at the sort of top 10 cryptocurrencies by market cap in the future, you're going to see many of them on proof of stake. To that end, do you think Bitcoin will be one of them? And I think you answered that. But if not, what are the advantages for Bitcoin remaining on a proof of work consensus mechanism?
Yeah, so that's also a tricky question. So because most tokens have a foundation and people behind it, they can do a conversion to staking, and all new things being built are being built on staking because it's the better technology. Because, as I said, nobody really knows who created Bitcoin and there's no foundation behind it. It's really about the consensus of the users. And frankly, a lot of the people really like the system, the proof of work system for Bitcoin, because it's been reliable for 12 years. It's never been hacked. It's secure, stable. And so it would require some really heavy convincing to get Bitcoin to move off of proof of work. I don't think it's going to happen. I think they will try and find ways to make the mining more efficient, but certainly down the road, I mean, look, it's really like sacrilege to say anything wrong about Bitcoin, and I like it, but certainly it has an image problem with respect to its energy use. I do not see that the people that I guess are influential in that system moving away from crypto mining. However, I think everything else that has a foundation and people behind it will be moving to staking.
Thanks. John asks, how are you securing the assets? Are you using third-party custodial services?
Yes, we primarily use Coinbase custody.
Great. And I think two people have sort of asked this. So one, how do you begin staking? How do you suggest, what resources are there out there for people to learn about staking? How do you sort of shorten the learning curve? Where should people get started?
Yeah, so the modern day encyclopedia is Google. You can certainly look it up, and there's lots of sites and places. If you go to our website in the top left under resources, we have some good articles on what staking is. But generally speaking, if you want to do staking, and one of the reasons I like staking is because the custody remains with you. There's no counterparty risk. It's not a loan. You can, if you have an account somewhere like Coinbase will give you an option. They charge you 25%, I believe it is, of whatever you are staking as their fee. Our costs are far lower. And again, if you're doing it through them, you'd be bound to the network. So if you go there and you start staking, I'm not sure they allow, but if you were staking Polkadot through Coinbase, again, you're going to have that 28-day lockup period. And so one of the advantages that Tokens.com offers as a public company is we do it for you. We provide do the security. You don't have the lockup periods, we do. And we also do the tax reporting and things like that, because when you buy a stock, you either have a capital gain or a loss, hopefully not. But reporting for taxes in crypto is still a little bit complicated. Like, how do you report all these trades and all these things? And so it's complicated, but the barriers to entry are low. If you had the time and resources to devote to it, I'd go to places, look up staked.us. There's Figment and a few other places. We can probably get some information on it. The other piece is, if you're going to stake ETH, there's a 32 ETH minimum requirement to do that. And so that might also be a barrier to entry for some people, plus the hold period. So you got to accumulate 32 ETH, which is a lot of money these days. And then you got to bond it to the network for what might be, 6 to 12 months.
Thank you. I think one final question here before we wrap up, and we do want to ask you about what lies ahead for Tokens.com. But just before then, somebody's asking about the relationship between liquidity pools and staking.
Yeah, so that, again, a complex question. I would say I'm probably not the best one to answer that. I know what liquidity pools are. We do not use them at Tokens.com. Like, we have more of a buy, stake, and hold strategy, but certainly there is a relationship. They're both part of the DeFi movement.
Oh, that's perfect. So, Andrew, just to close out here, you've discussed what you see as sort of the future of the industry, and you talked a little bit about your work in the metaverse. Can you just lay out what's the future look like for Tokens a year out, 5 years, wherever you'd like to leave us?
Yeah, so we had a great talk today on staking, but I've probably did 30 meetings in the last 2 weeks about Tokens.com. Nobody wanted to talk about staking. Everybody wanted to talk about metaverse real estate. And so I'd say that as we move forward at Tokens.com, we are going to continue to focus on staking as our primary objective. But we're really keen, and we'll devote some time and capital towards metaverse real estate. And again, if you don't know what the metaverse is, Facebook is converting their entire platform to the metaverse. This is going to be the largest rebrand in history. And you should read up on this, because within 2 years, every company is going to need to have a metaverse strategy, similarly to how they have a social media strategy today. And so this is like Web 3.0. This is going to revolutionize. It's already starting to revolutionize the way advertisers and retailers access consumers. And so please, I would encourage people on this call or Zoom to do a little bit of research into the metaverse. It's also just super cool.
Absolutely. And to everyone who's joined today, we'll share the presentation, we'll share a recording here, but we'll also share information on Tokens.com, as well as some of their investments in the metaverse, so you can get started to learn more about how you all are looking at this opportunity. So thank you so much, Andrew. Thank you to everyone who joined us. It's been a pleasure.
Thank you.